Hello and welcome to the Harwood Report for October 8th, 2017. As always, presented by Trade Academy. I am your host and the founder of Trade Academy, Keith Harwood. Let's get right into it. Disclosures. All services and content, as always, are provided for educational and information purposes only and are not intended as legal or financial advice. Trade Academy is not an investment advisor, not registered with the US SEC, not registered with FINRA. Everything I do here is the stuff that I go through on a weekly basis. You should do your own due diligence, make your own decisions. Options have risk. You can lose significant amounts of money if you do not understand the risk you are taking. So make sure you understand the risks you take before entering into any trade. With that, let's get right into what we're going to talk about today. I'm going to talk about our normal equity indices, S&Ps, NASDAQ, small cap, Dow Jones. I'm going to talk about Euro Stocks 50 today, though I think there's something interesting setting up there. Then we'll jump to the rates, forex, and commodities. Dollar yen still important. The dollar index, actually the ETF, there has some interesting trade potential. Gold, always correlated here to the dollar. Silver, very interesting. USO, there's a lot potentially going on this week. We've got potential for the White House to decertify Iran's sanction program. So basically, we've got some potential for some big movers here this week in oil between the hurricane and Iran. So I just want to look at the chart a little bit. I don't really have a specific trade idea there. I think we need to get some of the fundamentals out of the way before you execute a big trade in USO, but just know that there's a lot there. Sector indices, we're going to talk a little bit about the MLPs again and wrap up with XLP consumer staples. So with that, let's dig straight into the charts. Well, first off, let's look at fear and greed again. So last week I highlighted it was at 85. Thought, though, there was a chance that we get a little bit of a spike in the market. We got it last week. Now it's at 92. I mean, this is incredibly frothy. We haven't seen this kind of level in multiple years. At a minimum, you have to be cautious as a result of this. I mean, obviously, markets can always go higher. They can get more out of whack than what you think is reasonable, but this has got a lot of greed in the market when you look at the new 52-week highs, the volume summation, all the inputs that CNBC puts into their fear and greed index. But anyway, 92, just an extraordinary level. And was at 95 on Thursday, just pulled back a little bit with the conversation about what was going on in North Korea after non-farm payrolls. Non-farm payrolls looked like it was going to be, bearish for gold and things that and hit the VIX down a little bit, and then the North Korea rhetoric accelerated a little bit into midday. So let's look at S&Ps here. SPY ended up with an inside day on Friday. You see Thursday had an exceptionally good day. Really just a strong week. Broke out of that box there on the 27th of September or the 28th, something like that. And then we just rallied all week here off of it. I think we're going to do another consolidation. Sometimes after we get these runs, I was looking at it as a potential repeat of this. You do end up traditionally getting a little bit of a consolidation box there for a few days, if not a few weeks. These moving averages really kind of need to catch up to price action where we're at. You can see that we just don't get that far away from the 10-day moving average. Here we were trading at 235 with the 10-day moving average at just under 231. Here we're at 255 with the 10-day moving average at just under 252. So, a buck or two of upside over the course of the next week. But until these moving averages catch up and we do a little bit of price discovery up here, I just don't see the upside being exceptional. So that means this week might be a little bit sideways action. You may even see a little bit of a pullback. That doesn't mean I want to be bearish. I think generally speaking, the market is telling you have to stay long until we start pressing through some of this support. You want to be looking long, but there's some distance now between the normal support levels and where we're at. So there's a little more risk to it when you've got that kind of distance to your support levels. That's the flag for me. Qs are a little bit better than that. You're a little tighter to some of these moving averages, so you've got a little bit less. You can define your risk a little closer to where prices are. The NASDAQ, we talked last week about it trying to play some catch up. That finally started to come through a little bit Thursday and Friday, and Friday was awesome. It closed at the highs. It's a really good, strong close to the week. While S&Ps had the inside day and IWM had a little bit of weakness that we'll highlight in a second. NASDAQ looked the strongest. I think some money flow is starting to go back in there. You can see the MACD is looking a little bit bullish again here. You maybe just do a little 3-day run up to a new high. So you've got 2 days here. Maybe it's just one more day before some consolidation. But I think the NASDAQ, if any index has a chance to get a little run, it's going to be NASDAQ. IWM was the one that's had the most ridiculous run here over the last really almost 2 months, month and a half. Friday was your first, sort of concerning day if you're looking at it on the chart. It's not that bad. We still stayed in this sort of box that we're starting to form here in consolidation. We stayed above Wednesday's lows, but Friday had a lower high than Thursday and a lower low than Thursday. So there's a little bit of a flag. Still have some steep moving averages catching up to price action here. I think we're going to consolidate for another week, maybe pull back and retest the 10-day moving average. If that doesn't hold, obviously, then the 20-day moving average becomes your next support level. It just seems to me that given this type of run, where fear and greed is, where the North Korea rhetoric is, I don't necessarily want to be putting money into IWM as a long right now. Maybe if you break out of this, and make a new all-time high early in the week, you can try to press, but vol's not particularly cheap in IWM relative to the other macro indices, and I think there's other ways to play for bullish action that's a little bit easier to justify and a little bit cheaper to play in the option space than going into the small caps this week. Final U.S. Sector, we're looking at Dow Jones Industrial Average. It looks a lot like the S&Ps with the inside down Friday. Broke out of, you saw that box that was kind of forming here. We broke out on Monday, had 5 strong days. Looks really good. I don't see a reason to play it from the bear side, but again, I think I need to see a pullback or a consolidation before I'm looking to go here from the long side. Just NASDAQ's the easier long for me this week if I was going to go anywhere in these sectors. You can go lightly long, but I think if you're going to go long, it's going to be off of a grinding higher motion, and that's not really anything that I want to play here too aggressively. Nothing with outright options. FEZ, on the other hand, has got a little bit of interest here. That's the Euro Stoxx 50. So you can see there's been a little bit of chop here the last few weeks. We haven't yet broken out to new all-time highs. Friday was a really nice day for us. We had a little bit of weakness, closed on the highs. We're looking for this breakout here above that 41.31 level. That was the previous high. And it was made, that's the 29th, so we had basically the previous Friday. We're getting close to a level here where I think this could get a little bit of a spike to catch up. So if you're going to see money flow somewhere, maybe it goes into Europe. Held really well here at the 20-day moving average. It's been providing some support for us for a little bit. 50 may be a little bit stronger, but at least we're seeing it hold against the 20-day, 10-day. Everything's really good. We're above the moving averages. MACD's a little bit questionable here, but if you actually go into the volatility of FEZ, that's where I think you get your real edge. You can see implied volatility is sub 10%. Realized volatility has been about 8% recently, but if you get a breakout, that should jump up to maybe 11%. The key here for me, though, is if you go, yes, you can get very cheap here in the first couple weeks, but if we just consolidate for another week or two, I'm going to get hurt because the move didn't happen fast enough. If I go to October 27th and look at these 42 calls, first off, they're in nickel. It's exceptionally dollar cheap. Second off, they're 8%. That's exceptionally vol cheap. We don't get that low in vol traditionally. Maybe we get there because you never know how low they're going to hit vol in these other products. It's a little bit of an outlier here. It's only a 13 delta. Sorry, it's not just a little bit. It's an outlier there at 13%. But I think you get a lot of leverage getting long these in nickel. 8% implied vol, ready for a breakout, cheap upside. This is just a way for me to play this potentially that I think has some good upside. There's not a lot of trade that comes into FEZ. You can see the open interest is pretty minimal here on October 27th. That's your biggest concern. There is some open interest here on October 20th. But I don't want to go short dated here. There's no value to me in being into these October 20th 42 calls. It just doesn't give me enough time with only 2 weeks. I can play the 8% vol here with the October 20th 41 and a halves. And if I can get those, if I can't get these October 27ths, maybe I'll go into the October 20th 41 and a halves. Those are a little bit higher probability, closer to a 30 delta. But I just like the leverage that you're getting out of these October 27th 42 calls. So if you get something that causes global equities to rally, this is the one that I think has some really good leverage to it with volatility as cheap as it is. So that's your macro trade for me, is FEZ over any of the others. Let's go to USD JPY. Start looking at the commodity trades we want to focus on here. So first off, we've got dollar yen. And you can see here that the dollar yen is still holding above the 10-day moving average. We keep testing it. It's been, a bit of a question whether it's going to hold, especially Friday. If you actually zoom in here and look at the hourly chart on Friday, this looked like it was ready to take off. It's going to be very bearish for precious metals. Very bullish on yield. Just generally speaking, the dollar was ready to go. And then right here, started talking about potential for a North Korean missile test and Trump's comments about, sort of a calm before the storm, and who knows what that means in terms of macro rhetoric and everything else. Well, guess what? Every time we've seen these, it's meant nothing to the market. It's had a temporary impact, and that temporary impact was the pullback to the 10-day moving average. And as long as nothing happens this afternoon and into the evening and into the morning, I expect to see the dollar firm again. And getting back towards Friday's highs, looks like it's getting ready for a breakout to push up here towards 114.60, whatever, maybe even up to 115. That's not good for precious metals. Similarly, it's also very good, obviously, for the dollar. You can see the dollar index ETF had that same kind of action on Friday. I go to the hourly. There's a little less time window here because it doesn't have the pre-market stuff, but we were trading on the open here at 24.50 basically. High was 24.47, and then when that rhetoric came out, we dropped down to 24.36. Doesn't sound like a big move, but UUP is a low volatility ETF. The dollar index just doesn't move as much. With this rhetoric not really meaning anything this week, I think we're going to not just retest, but I think we're going to blow through the 100-day moving average here at 24.5. So that gets me to my trade here. We go over to UUP. Look at the volatility. Like everything, volatility is pretty cheap here. Doesn't traditionally get much below 6. I mean, we had this little period here where we got down to 560, whatever. 6.5 is pretty dang cheap. Realized volatility's been been above 6, so I don't see us getting below 6%, especially in the gamma intense months. So when I look at the options here in UUP, I'm looking a little bit further back. I like to get another non-farm payroll, given the non-farm payrolls this month were generally bullish for the dollar. Let's get another non-farm payroll in, especially when vol's this low, and that means options are very cheap in general. So I'm looking at this 24.5 call here for 12 cents. If we blow through the 100-day moving average of 24.5, these things quickly get in the money. And if I look at this chart, I mean, there's no reason to expect really any resistance until you get kind of up to this consolidation area back closer to 25 bucks. So you get through here at the 100-day moving average, I'm looking for a move towards 25. That gets you some pretty good R&R out of these November 3rd 24.5s that get the benefit of sort of buying the dip on the North Korean news. Because there was no dip in the equity markets. It was just in the dollar, and there was the bid in gold. This is my way to play that. If North Korea was a real problem, you got to see equity markets drop something here. So they only, really filtered that rhetoric through to a few ETFs, the dollar, precious metals. They didn't even put it into like EWY, the South Korean ETF. So this is where we can play it. Then we can take advantage of the fact that either this was mispriced or the other markets should have gotten, the other equity markets should have gotten sold off. In which case, we're going to see some opportunities early in the week to try to buy some puts with volatility generally this low. But since I haven't seen that rhetoric, I'm going to look at the bullish side of the dollar. November 3rd, 24.5 calls, 12 cents, great R&R. So we talk a lot about gold when we're going into these ETF plays off of that dollar yen. So as long as that dollar yen stays above the 10-day moving average, I got to stay bearish on gold. You can see, much like the inverse of the dollar yen and the dollar move, gold looked ready to fall out of bed, Dropped all the way down to 119.80. What was it? What was the low? 119.80. Exactly. Okay. 119.80. And then spiked up to 121. And basically closed around 121. So the downside to gold very clearly is back below 119.80. I mean, without North Korea rhetoric going in, we're shooting below 119.80. We're probably pushing here towards 118.80. The 200-day moving average. That's been our sort of ultimate target. We did a little bit of trade around the 100-day moving average. Now let's shoot for the 200-day moving average for the bearish side. I don't love the options in gold, though, for the obvious reason that while they're a little bit cheap, just look at this volatility. It's only a little bit cheap, 10.5%. You know, and if gold gets bullish, it goes to 12%. But on a bearish scenario, it goes to, sub 10. So why would I play an outright option and trade Vega in GLD? On the flip side, or as a similar trade with a little bit more leverage, maybe I go to SLV. SLV is already below all the moving averages. It's just retesting the 10-day moving average here. And there's not a lot of support here. Maybe you could claim there's some support there at 15.25. I mean, 14.5. Well within reason. If people are bearish on gold, they hit silver a lot more too. So if the dollar's firm, dollar versus yen is firm, gold is weak, silver's going to be weak. And if I go to SLV, you can see that the volatility is closer to the low end of the range. The low you get really is just about 16%. The high end of the range is in the 20s. That usually happens in a bullish scenario, but our vol here at 16.5 or lower is about as cheap as it gets. If I go out a full year, you can see that an average volatility is closer to 21, 22%, even when the market's not been particularly exceptionally bullish all year. Realized volatility has been a little lower, but it looks like it's ready to come back up again. So you get this turn up, and maybe it gets to 17%. So, you're getting the benefit of defined risk as well as a little bit of leverage buying this cheap vol. And I definitely want some defined risk if something changes with North Korea. So in SLV, again, I like getting that benefit of another non-farm payroll if I'm right. And if I look at these November 3rd 15.5 puts for 14 cents. There's a number of reasons I like these. Number one, obviously I'm bearish and thinking this could get a big pull down. Number two, let's look. What was the low on Friday? The low was 15.42. These puts were 8 cents in the money on the low on Friday, and then the market spiked up, and these are still only 14 cents because of the fact that the market rallied up towards 15.85 off of the North Korean rhetoric that I keep talking about. So I think this can get a really nice bearish flow here, especially if the equity markets consolidate rather than pulling down, especially if the dollar continues firm. I could see these things being 15 cents in the money as early as Monday afternoon. And that's why I really like these by 14 cents. I think SLV, if it's trading anywhere near unchanged on Monday morning, you've got to be looking at the 15.5 puts. And if we open lower, you can go down to these November 3rd 15 puts, knowing that support was closer to 14.5 for the ultimate, crash trade. That's down here. I'm not necessarily playing for the crash trade if I'm getting into the 15.5 puts. I'm looking for the pull down here towards 15. But if you want to play crash trade, 15 puts, they may not be much more than a nickel, even if the market's down about 15 cents on Monday, because volatility tends to get hit on breaks in precious metals. So keep an eye out for those as well. Let's now step away from the metals and just look at oil. I'm not going to do anything with a trade overall on oil, but I do want to bring up a couple of things here. So last week we were talking about how being above the 200-day moving average and all the key moving averages here was a really bullish input, and then some things kind of started coming out about OPEC and yada, yada, yada. Basically what you needed to know was that there was enough of a bearish input to push the market back down to this area that it had consolidated before getting its bounce up the previous week. But then Friday, non-farm payrolls come out. It's a little bit bullish the dollar. You've got some stuff talking about Iran, and basically everybody kind of with the hurricanes. Everybody came in with a little bit of a bearish oil view. I don't know for sure how the market will interpret it after the hurricane's over or after we decertify the Iranian situation. But I have to watch this because volatility has been very cheap across all the oil names. And if it's not After we react in USO, that's going to flow through. I mean, you look at XLE, it looks like it's rejecting the 200-day moving average, and volatility is cheap. That said, if oil firms Monday, Tuesday, Wednesday, Thursday is the Iranian decertification expected day, then you're getting explosive here, and you want to look into OIH again, and all these plays that we were talking about in the last couple weeks. Right now, I don't want to make a big play because there's some fundamental inputs that are going to be coming to the market this week. As those fundamental inputs get digested, that's going to get me a little bit more excited about putting on the plays, because then I'll get a little more clarity. And because I know volatility is already cheap, I mean, I could buy a strangle here, but I'm looking for directional clarity rather than just buying the cheap vol that it could play out. But it's not my favorite way to trade this right now. AMJ, on the other hand, has an interesting setup because it's the oil sector, it's the MLPs. People have been talking a little bit about how MLPs are getting some benefit from the way the tax reform, tax cuts, whatever you want to call them, have been written. And it's the way that they are structured with 1099s could be very bullish for MLPs. Started hearing a little bit about it early last week or late the week before when the tax reform stuff started coming out, and you're seeing some flow in here. I mean, dips are getting bought. We may be opening low and then just rallying, and we're closing near the highs every day last week, looking ready to just, maybe we stop at 29. I don't think it's going to happen. And last week, I talked about this being an interesting sector rotation play. I think this is getting a little bit more of a tailwind here, starting to get ready to go. I think people are putting money into the MLPs because of this tax reform theory, and I don't think it's necessarily going to get hurt by oil price movement. And so I'm sticking with my same trade here. Again, let's look at the volatility here. It's 14%. It doesn't get cheaper than that. Normally we're 17-ish%. And my trade last week I was looking at, it's the October 27th, 29 calls. They're still only 20 cents. That's 13 vol. That's ridiculous. I think it's just giving you a really good R&R to trade for that breakout through the 100-day moving average in a sector that looks like it's getting some money flow. So I like AMJ a lot from that perspective, and these for 20 cents I think are going to give you a really good risk-reward profile. All right, and then we got one more. Last one, XLP. So I liked it from the bear side last week. Thursday started to concern me. Wednesday honestly didn't. It was just a retest of the 10-day. Thursday looked like we were at least going to test the 200-day moving average, and maybe we were just going to flip this little bearish flow on its head. But then on Friday, it just made it clear. Consumer staples, they can't be bought right now. And we're ready to break down. We're closed below the July 11th low. We've been in this range consolidating for long enough. It's basically a flag here, ready to break down. Any down move basically gives you the breakdown. This looks pretty bearish to me. Fear and greed at 92. Let's talk about that again. The market's looking for some things to sell when there's that much sort of greed in the market. And this looks like an obvious candidate to me. So we look at XLP. Again, let's look at the vol. It's come up some. It's 9%. I don't see it getting back down here. That was just a ridiculous low. Maybe 8% is the low. But in a bearish environment, 11%, 12%. You can see that get up there in terms of implied volatility. And more importantly than anything, you can get some momentum if we break that low from last week, basically. So if we get any downticks here, you could get some momentum selling into this, and that gets this market a pretty good amount of downside, and you get some cheap options here going into October 20th, 53 puts for 11 cents. Last week we looked at these ones for 19. They're still there, still under 10 vol. I'm going to look at it for a little more gamma, 10 vol, 11 cents. It all depends upon which one you can get into. If you can get into these for 11, maybe 12, you're in pretty good shape. If not, then go back to the 27th. Look at these guys, try to get in for 18 or 19. I'd rather pay 20 on these than 13 on the October 20th. You know, it's just nuanced, but saving a penny here and there is always kind of nice. So I think in general, you're looking for this 53 strike in XLP, looking for this to get a potential for a decent size break in the next 2 to 3 weeks. 2 weeks gets you through the 20th, 3 weeks gets you through the 27th. So, you know, I think you got to stay with these. And because of that little bit of dollar cheapness and my expectation that this is going to get some selling this week as fear and greed starts to come down, and as you start to consolidate the macro indices but need to find some sectors to sell, this is the one that I think is going to get some of that selling pressure. And so that's why I'm looking at the October 20th 53 puts this time. So that was it. As I said, you know, I'm generally bullish, but the Qs are the cleanest bull story to me, and IWM is actually sort of the weakest bull story for now. Longer term, obviously, IWM has been much more bullish than any of the other sectors, but it just needs some more time to consolidate before it can get its next leg higher and get a little more clarity in the chart. FEZ was the interesting way to play it for me, with Euro stocks having lagged a little bit. Rates, forex, and commodities, dollar got a little bit of selling off of the North Korea rhetoric, and I don't think that's going to follow through into Monday morning unless that rhetoric actually turns into action. As of now, there's no action, so let's assume that that's going to stay through. Dollar will then become much more bullish again. You can play it through the dollar index. You can play it through bearish silver. I think those are your interesting ways to do it. Oil, we've got a lot of potential news this week, and the one sector that I will play without having that news clarified is probably the MLPs, just because I think that's more of a tax reform play than the oil stuff going on this week with hurricanes and the Iranian sanctions and the potential for decertification there. And finally, consumer staples look like the weakest subsector for me, and that's the sector that I would be leaning as a good bear candidate for the market as a whole, as the market tries to consolidate, digest, and look for some shorts to go against the massive long that they've been putting on, with the markets rallying to new all-time highs and everything looking so rosy. A reminder, guys, the Harwood Report. So this is the premium version of what I do. I do a weekly newsletter. I do a midweek update on the videos. Those are the premium elements. As we go along, I will incorporate some instruction on how to pick some of these option structures for setups in that midweek video. The midweek video is sort of a let's talk about digesting the market, much like we've done today. Just, you know, if stuff changes on Monday and Tuesday and Wednesday, then we need to be able to react midweek. You know, there's a lot of other stuff that I go into the newsletter, more complicated trades than just these individual outrights. The outrights I think are interesting as a way to play for some places that have some exceptional R&R setups, but there's a lot of nuance that you can trade with options. I'm selling this for $49 a month. Right now, you get your first month for free. Once I get to 100 subscribers, we're going to get rid of the free month. But, you know, the first 100 people get that first month for free. It's worth checking out. Last week, I had some really good ideas. I'll actually show you where they are. But, you know, you go to tradeacademy.co/Harwood Report if you want to sign up. And last week, you know, we can talk about the newsletter ideas here. The average return was 38%. The one big loser was, unfortunately, this GDX. You know, Friday, they bid the hell out of GDX. I like silver a little bit better on the short side, but gold miners, I think, are actually going to be just as interesting for a short side play here going into next week, as I talked about. But you can see I had some ideas at the S&Ps, NASDAQ, small caps, and a lot of these are a little more nuanced, like call calendars that return, you know, triple your money effect, or that tripled in value, almost tripled in value, and some other nuanced stuff, diagonals and things that worked out really well, even though the market didn't really do much. So, you know, I just want to bring that out there. Take a look at them. I put the sample newsletter on the site there at tradeacademy.co/Harwood Report, so you can take a look at those and see what you think about it. But yeah, I hope you guys get enough value out of the free video that you're willing to try the premium version, again, for free for a month, and then see what you think. Feel free to contact me. Website's tradeacademy.co, email keith@tradeacademy.co, phone number 312-600-8004, and follow me on Twitter @tradeacademyco. I throw out my watch lists every morning and some in the afternoons, as well as a few trade ideas that I think you guys might get some value out of. Have a great weekend, and we'll talk to you soon.